America just cut a deal with India that was supposed to punish Russia, and within weeks, gold crashed 20% in a move so violent it looked like someone pulled a fire alarm in a crowded theater. Here is what they are not telling you. That same deal is funneling cheap Russian oil straight to China at a $20 per barrel discount, while India pays full price for American barrels. The gold crash was not traders panicking. It was a margin hike that forced out anyone trading on borrowed money right before the real buyers stepped in. You are watching a 3-card Monty in real time. The card you are supposed to watch is Russia getting squeezed. The card they do not want you to see is China, walking away with cheaper energy than anyone else on the planet while gold rebounds the second the weak hands got flushed out. If you think this is just boring trade policy, look at the numbers. India was buying 2 million barrels a day from Russia at up to a 25% discount. That is $40 million of savings every single day, keeping their electricity cheap, their diesel affordable, and their factories competitive with yours. Now America says play ball or face sanctions, so those barrels do not disappear. They just shift to Beijing at an even steeper sale price because the seller is desperate and the buyer knows it. While that happens, gold drops from 5,300 to 4,400 in days. The bull market is supposedly over, and physical buyers in Singapore and China are lining up treating it like a clearance sale. I am going to show you how this deal actually works, why China's just got handed a massive advantage, and what I am doing with my own money right now. By the end, you will have the simple scoreboard I use to spot these games before you become the exit liquidity. Welcome to the channel. If you are new here, I show you what is actually happening behind the candles, in plain English, no jargon, no hopium. Just the rigged game, step by step. If you want someone in your corner when the big players are running games with your money, subscribe, like, and hit the bell. Remember, this is entertainment, not financial advice. I could be wrong. Think for yourself and never bet the house on a single trade. Now let me show you what everyone thinks is happening here, then we will flip it around. Most people think America just pulled off a master move. They cut tariffs on a big slice of Indian goods from an effective rate near 50% down to about 18%, and tied that tariff relief to India gradually stepping back from Russian barrels and shifting more of its purchases toward US and allied suppliers. And boom, problem solved. Less cash for the Kremlin, more exports for the United States, India locked in as a strategic partner for the next decade. In reality, you cannot just wave a flag, announce a tariff cut from an effective rate near 50% down to about 18%, and pretend the rest of the math does not exist. You are not cutting a Netflix plan. You are trying to rearrange hundreds of billions of dollars of energy and trade flows that took years to build up. Here is the basic picture in simple numbers, so it sticks. Before all this drama, India barely touched Russian crude. A few tens of thousands of barrels a day. After the first round of sanctions on Moscow, that flipped. By mid-2023, India was pulling in something like 2 million barrels a day from Russia, making Moscow India's top supplier by a wide margin. That is not a footnote. That is a complete rewiring of where India gets its energy. The reason is simple: discount. Russian barrels have been trading at a big haircut to regular benchmark prices. Call it a 20% to 25% sale, sometimes even more when new sanctions hit. That discount goes straight into India's cost base. Cheaper electricity, cheaper feedstock for plastics, cheaper fertilizer for farmers, cheaper diesel for trucks that move everything around. If you give an industrial country that kind of fuel sale, you are not just helping its refiners. You are cutting the cost of almost everything that leaves its ports. At the peak of this relationship, India was buying roughly 2 million barrels a day from Russia, often at discounts of up to $20 below the regular price. Imagine that peak math for a second. At those peak volumes and discounts, that is about $40 million of savings every single day compared to paying full freight. Stretch that over a year, and you are staring at something around $14.5 billion of extra room in the system. $14.5 billion is not a rounding error. That is the kind of money that lets you keep power bills lower, undercut rivals on export prices, or build more roads and factories without blowing up your budget. Inside New Delhi, that is not a neat number on a slide. That is the gap between angry voters and slightly calmer ones. Higher fuel costs show up fast in cooking gas, bus fares, and the price of basic food. At the same time, every senior official knows that if Washington ever decides India is still too close to Russian barrels, the threat is not a mean tweet, it is pressure on banks, on dollar clearing, on big state refiners that need foreign finance, so they are stuck staring at a menu with no good options. Stay on the cheap Russian oil and live with a constant sanctions gun pointed at the banking system, or lean into more expensive, friendly barrels and live with inflation and budget stress for more than 1 billion people. That is the bind. It is not stupidity. It is a choice between pain today and a different kind of pain later. Now picture that discount getting yanked. Suddenly those same barrels, or their replacement from a different supplier, cost close to the regular global price. The difference has to be paid by someone. Either the government eats more of it in subsidies, or households and factories get the bill, or both. That is why this deal looks insane on paper if you take the talking points at face value. You are telling me India is being asked to give up a huge chunk of those built-in energy savings, direct more of its import bill toward a smaller club of friendly suppliers, and is supposed to smile and say thank you because a big set of tariffs on textiles, tech gear, and other exports just dropped from around 50 to around 18%. So why would New Delhi even entertain something like this? Part of the answer is pressure, plain and simple. Since Russia invaded Ukraine and the sanctions started to snowball, Washington has been hunting for ways to cut into Moscow's oil cache without blowing up prices for its own voters. Getting India, a huge new buyer of Russian barrels, to at least pause or slow those purchases looks great on a podium. And to sweeten the deal, the United States can dangle lower tariffs, access to American technology, and a clear path away from secondary sanctions. The problem is that markets do not care about podium speeches. They care about margins. Here is where the story flips from simple diplomacy to a quiet gift basket for Beijing. If India really does trim its Russian purchases in a serious way, those barrels do not stay in a warehouse like unsold toys. They get rerouted. And who has the refinery capacity, the appetite, and the political willingness to soak up problem barrels when they come with a big cut to the sticker price? China. Now think about what happens to one of those cargoes in the real world. A trader lines up a shipment for an Indian refiner, then gets a call that the bank does not want to touch the payment, or the insurer is suddenly nervous about sanctions risk. The deal stalls. The oil is still in the water, so the trader starts dialing for another buyer. A Chinese refiner picks up, knows the cargo is now awkward, and demands a deeper discount for taking the heat. The ship changes course, maybe through a ship-to-ship transfer, and that crude ends up feeding a plant on the Chinese coast instead of an Indian one. Out the other side comes diesel, gasoline, and chemicals that can be sold at sharp prices. On paper, that looks like punishment for Russia. In reality, it is a coupon for whoever said yes to the awkward barrels. Chinese refiners have already been taking in discounted crude from Russia and Venezuela for years. Some flows show up clearly in customs numbers. Others sneak around through ship-to-ship transfers and creative paperwork. What matters for our story is that when India steps out of that line, China can take a bigger share of the sale rack. Put yourself in Beijing's shoes for a second. You get to buy oil at a steep discount because the West wants to punish the seller. You refine that into fuel and chemicals. Your factories get cheaper energy than your rivals in Europe and possibly in India. Your exporters can shave prices without destroying their profit margins. And as a bonus, you can lobby for a stronger local currency because cheap imported energy helps offset the pain. Most people think sanctions starve the target and everyone else just carries on. In reality, sanctions often reroute the feast. The calories do not disappear. They move to whoever is still allowed to sit at the table. We have already seen this movie. When sanctions hit Iran, its oil did not stay underground. It moved through workaround channels, often at a discount, to buyers who were willing to live with the political noise. And some of those deals were not in dollars. When Venezuela was squeezed, the same thing happened. Crude that could not go straight to one big customer found a way to others through new routes and new paperwork. Each time, the target took a hit, but so did the idea that the dollar system could block every sale. This India deal is not some new clean weapon. It is the same old play, with a different jersey and the same side effects. That is exactly why this India-United States deal is such a dangerous story for anyone who cares about fair competition in global trade. Let me zoom out and give you a bit more context, because this is one of those moments where a few facts change the way you see the whole board. In the last couple of years, Russian oil has bounced around at some of the deepest discounts we have seen in modern times. We are talking situations where their main export blend trades more than 20% below the regular global benchmark when new sanctions hit. At the same time, Russia has become India's top crude supplier, at times shipping close to 2 million barrels a day. That is a giant share of India's energy diet. Now, the newest round of sanctions on big Russian producers and traders has started to pinch those flows. Volumes into India dipped in recent months as banks and shippers got nervous, while OPEC producers clawed back some market share. So into that fragile moment, Washington walks in and says, "We will cut tariffs on your goods from roughly 25% back to 18% if you move away from Russian barrels and tilt more toward us." On a spreadsheet that looks clever. In the real world, you have refineries that were literally retooled to run on cheap Russian blends, contracts with traders that do not unwind overnight, and an entire export strategy that now leans on lower input costs. So what happens if India actually sticks with this pivot? 1. India's energy import bill goes up, maybe by tens of billions over time, compared with sticking with full access to discounted barrels. That means more pressure on the rupee, more pressure on the budget, and more pressure on regular people every time they flip a light switch. 2. The Russian barrels India does not take are increasingly being redirected to China and other buyers willing to live with the sanctions risk. Those buyers demand a discount to compensate for the trouble. So Beijing gets cheaper fuel while its main rival in Asia gives up some of that edge. 3. When you combine all that with a global trade picture where China is already running a huge surplus, you are basically telling the world that the punishment for Russia involves feeding more cheap energy into the Chinese export machine, while squeezing margins in India and keeping Western voters in the dark about who really benefits. And 4, you quietly push more people into hard assets because the message is clear. The rules of the system can be rewritten at any time, and your country can be used as a pawn in someone else's sanction game. That is where gold and silver come back in. Most people think gold just trades off whatever the Federal Reserve does with interest rates. Whoever chairs the Fed hikes, gold down. Whoever cuts, gold up. Nice and simple. In reality, gold is also a giant pressure gauge on everything we just talked about. Currency wars, sanction games, energy discounts, capital controls, the whole mess. Look at what just happened. We had a monster run in gold where the price blasted to levels nobody even wanted to say out loud a few years ago. Then in one brutal move, the price dropped by around 1/5, all the way down toward that 4,400 zone. Some of that move lined up suspiciously well with a margin hike on precious metals futures. Suddenly, anyone trading paper gold and silver needed to post a lot more collateral to hold their positions. If you are over-leveraged or running tight, you cut. You sell. You get taken out by force. That is how you flush weak hands without changing the long-term story one bit. Here's the simple way I want you to picture it. A trader is long a bunch of gold futures. They still like the metal. They still think it goes higher over the next few years. Then the exchange says, you need a lot more cash on the table to keep that bet. Maybe their lender will not extend more credit. Maybe other positions are bleeding. So they are forced to dump contracts into a falling market just to survive the week. That selling is not a calm vote that gold is now trash. It is a margin fire sale. At the exact same time, a person with no leverage and some spare cash sees the lower price and walks into a dealer to swap paper money for metal. That is how you get a red screen and a busy bullion shop on the same day. Here's the crazy part. As the paper market puked and charts went blood red, the real world did not behave like the pundits on television. In Asia, people were lining up to buy the dip. In Singapore, queues formed at bullion dealers, and even at the one bank that sells physical bars to regular savers. In China, bar and coin demand has risen so much that it now rivals jewelry demand. Central banks, especially in Asia and the Middle East, have been adding to their gold holdings for years. And Beijing's central bank has just logged 15 straight months of reported gold purchases in this latest streak, on top of an earlier 18-month run before a brief pause. That is not panic. That is a long-term, slow-motion vote. Think about that for a second. Gold makes a record, drops hard, and instead of a rush for the exit, you get people treating it like a Black Friday sale. That tells you the story is not over. The big money sees this as a reset, not a top. We need to talk about why. Remember that energy story. India gets squeezed on its cheap oil. Russia sells more to China at a discount. China's factories keep humming on cheaper inputs while the West tries to juggle sanctions, elections, and angry consumers. At the same time, the United States is nominating a new Federal Reserve chair who is supposed to balance Trump's demand for lower rates with Wall Street's fear of inflation. After years of wild money printing, and then aggressive tightening. That is a recipe for confusion if you only look at bond yields and stock indexes. But for gold, it is pretty simple. If central banks are trapped between keeping borrowing costs low enough to stop debt from imploding and keeping the currency strong enough that imports do not run away, something has to give. Usually, it is the currency that quietly gets sacrificed over time. Not in a single day crash, in a slow leak. Investors around the world can feel that. You do not need a PhD to understand that when global gold demand hits record tonnage, when central banks have been buying around 1,000 tons a year, over 1,000 tons 3 years in a row up to 2024, and only slightly below that in 2025, and when the price in dollars jumps by more than half in a single year, people are voting with their savings. They are saying, I do not trust you to keep this up without breaking something. And when you layer on top of that a policy mix where the White House is pushing for lower rates to keep stocks and housing afloat, while the incoming central bank chief has a history of criticizing giant balance sheets, you get a nervous system where every speech and every press release can yank markets around. That is why you saw gold get hammered right after the latest nomination news, only to start clawing back once the dust settled and people realized nothing in the underlying story had actually improved. Let us circle back to China, because this is where the oil story and the gold story join. While all this is happening, China's money supply keeps growing faster than the size of its economy. We are talking broad money up around 8 to 9% a year recently, while growth trundles along in the mid-single digits. That means more and more cash searching for a home, even as real estate looks shaky and local stocks give people headaches. Where does that extra liquidity go? Part of it goes into technology and state-backed projects. But a big slice has been moving into gold, not just through the central bank, but through regular savers who buy bars and coins because they do not fully trust property or the local stock market. Gold demand inside China has hit some of its highest levels in years when you add up investment buying, even though jewelry demand is struggling. Now connect the dots. China gets cheaper energy because Russian barrels need a new home. China keeps adding gold to its reserves. Chinese savers keep adding gold to their private hoards. And Beijing quietly talks up the idea of a stronger local currency that can play a bigger role in global trade, backed in part by a rising pile of metal. Here's the quiet deal they are really running. First, they take on the diplomatic risk of buying from sanctioned or squeezed suppliers, but they demand a lower price for that trouble. That gives their economy cheaper fuel than many of their rivals. Second, they let some of that savings show up as steady gold buying, both in the official reserves and in private hands, so the system slowly swaps some paper claims for metal. Third, they push a bit more trade and lending into their own currency each year, so partners get used to settling bills without dollars. Put those 3 steps together, and you get a story they can sell to other countries. Trade with us, pay in our money, and know that behind it we have cheap energy deals and a growing pile of gold. There is no magic coin. It is slow balance sheet work that makes them a little less dependent on Washington every year. You do not need to believe in some secret gold-backed currency plan to see the basic direction. Cheaper imported oil plus steady gold accumulation is a strong combo if you want to present your currency as a serious alternative over the long run. Meanwhile, on the Western side, you have a United States that still runs big deficits, still leans on the dollar's special status, and now is signing trade deals that may accidentally weaken some of its friends while helping its main strategic rival to buy better inputs. So where does that leave you, the person watching this with a regular job, a small investment account, maybe a stash of coins in a drawer? Let me make this simple. There are really 3 groups of people who walk out of this kind of environment. The first group sees the headlines, believes the press conference version, and keeps thinking this is all normal politics. They assume energy flows will adjust with no side effects, that sanctions mostly hurt the target, that gold is just a shiny inflation hedge that already had its run, and that the smartest move is to keep doing what worked in the last decade. They will get surprised again and again when their cost of living creeps up faster than their wages, and when their safe assets do not behave the way they expect. The second group sees the chaos and panics. Every time gold drops a few $100s, they sell. Every time there's a rumor about a deal or a nomination, they chase whatever is trending on social media. They jump between memes, futures, and options, trying to outrun the storm. Some get lucky. Most end up as exit liquidity for more patient players. The third group understands that the system is not fair, but also not instantly doomed. They accept that they cannot control what Washington, Beijing, or New Delhi do. They focus instead on 3 things they can control: how much debt they carry, how much real savings they keep outside pure paper promises, and how emotional they let themselves get when charts swing. People in that third group watch deals like this India-United States package not as fans or haters, but as signals. If the result is higher energy costs for key exporters and even more cheap barrels for China, they understand that global manufacturing advantage continues to tilt one way. If gold crashes on a margin hike and then roars back while physical buyers refuse to sell, they see that as confirmation that the long-term trend is still up, even if the path is brutal. Here's the simple scoreboard I keep in my head, and you can copy it on a sticky note. 1. Watch India's actual crude import mix, not just the speeches. If Russian barrels are still slipping in through side doors with new labels, you know the deal is weaker than advertised. 2. Watch how many of those same Russian and other discounted barrels show up in Chinese import data over time. If that line keeps climbing, you know who's really feasting. 3. Watch central bank gold purchases and bar sales to regular people when the price dips. If those stay strong on every smash, that tells you the real demand is still there. 4. Pay attention to margin rule changes on metals futures around big moves. When the rules jump right as price spikes, that is your reminder of who controls the lever. You cannot control any of these, but you can control how blind you are to them. Personally, I am in that third camp. I'm not selling everything and hiding in a bunker. I'm not livering up on crazy futures bets either. I'm trimming paper exposure when volatility gets insane. I'm adding to physical positions slowly when fear is high and premiums are reasonable. I am watching how India actually behaves in the next few months, not just what Washington says on television. And I am looking at Chinese energy imports and central bank gold flows as my real scoreboard. 6 months from now, you might look back at this moment and see it as a turning point that nobody on mainstream television framed correctly. If India quietly keeps more Russian barrels than the press releases suggest and treats the United States deal as a flexible option, they may manage to play both sides and keep some of that energy discount. If they fully commit to more expensive supplies and long-term fixed purchase promises, you will likely see their export competitiveness squeezed while China doubles down on discounted fuel and gold accumulation. 5 years from now, people may look back at 2025 and 2026 as the years when gold stopped being a fringe asset and became a core savings tool for regular households in Asia, while Western investors were still arguing about whether it was too high. So here is my simple ask. Do not let yourself be the extra in the background of this story. Do not be the person who only finds out that the rules changed when your energy bill jumps, your currency buys less, and your broker app tells you that your margin went up and your positions are gone. You do not have to predict every twist. You just have to understand that when you see a giant trade deal that looks like it punishes one country, you should always ask who gets the cheap inputs next. When you see a violent gold crash that lines up with a margin hike and then a fast rebound on strong physical buying, you should treat that as a lesson in who is really in this for the long haul. Most people think the market is a scoreboard of how strong the economy is. In reality, it is more like a plumbing diagram of who gets cheap fuel, who can print money, who can change margin rules, and who is quietly stacking metal while everyone else argues on social media. If you got value from this breakdown, subscribe, hit the like button, and share this with one person who keeps asking why gold is acting crazy or why every punishment for Russia seems to leave someone else with a better deal. Stay safe, stay calm. Do not be the exit liquidity.